What is happening, best ever listeners? This is Matt Faircloth, and welcome to the best ever CRE show and my segment called Next Level CRE, helping you bring your real estate investing business to the next level. Before I get into the show, and this is a next level show as always, but before we get into that, I want to mention to you guys the next level for you, which is Best Ever Con, coming up in February of next year, 2026. You guys want to be there because it is the 10th best ever. There's lots of surprises up our sleeve at the Best Ever Group that's going to be coming your way. There are a lot of really interesting things coming down the pipeline with regards to speakers and events and networking and speed dating between GPs and LPs. All of that stuff is going to be going on. There's going to be lots of GP putting deals together. There's going to be lots of LPs putting dollars into GPs deals. You guys, whichever one you are, looking to invest passively or looking to put operational systems together for those that want to invest passively in alternatives like real estate. If that's you, we want you there because there are going to be lots of people that are doing what you do and a lot of people looking to invest in things that you do at Best Ever Con. So what are you doing? Go to besteverconference.com. Use the coupon code PODCAST10, PODCAST 10, podcast10, all capital letters, podcast10. As your coupon code to get 10% off. So go ahead and do that. And I will see you guys at Best Ever Con, where I will be there with bells on, as will all the other Best Ever hosts. It's going to be a ball, a party, 10 pounds of conference in a 5-pound bag. It's going to be amazing. I'll see you guys there. Now, today's show, guys, I want to give you guys a quick highlight. There's a mantra, right? Observe the masses and do the opposite. And in other ways, if you do in your business, if you pursue things that are easy for you to do, they are likely easy for others to do as well. And that is by doing things that are simple and are just like, oh, I'm just going to look for a good cash flowing deal. Right? If you tell yourself that, well, guess what? Everybody else wants that too, right? So if you just say, I'm going to go find a good cash flowing deal I can close on quickly, right? Well, that's kind of what the masses want, right? But if you pursue something that the masses is not willing to deal with, that the masses are not willing to tolerate, so to speak, you might be able to find yourself great, phenomenal deals. That's what today's show is all about, is about finding niches in your space, whatever that may be, that are a little bit lower down the demand curve, meaning like they might not be willing to put up with the pain in the neck for whatever the thing is. So think about that. That is your overarching question to ask yourself in today's episode. That is the overarching theme of today's episode, is what is a little more difficult? If you are willing to go out there and work a little bit harder or deal with a little bit more of a challenge than your competitors are, you will be more successful, because most people do not want to put up with the BS that comes from slight difficulties in finding deals. They want the low-hanging fruit, right? Guess what? We all want low-hanging fruit. Who doesn't, right? Most fruit is not low-hanging. Most fruit is up the tree. Okay. So today's episode is about getting up that tree a little bit and finding opportunities that might be just a few rungs up, not that far up, not the top of the tree, just a little bit out of most people's reach or for what they're willing to deal with. So let's bring in Dave Kamara, who's going to talk to us about how he's been able to build a phenomenal business by doing deals a little off the beaten path. Maybe you guys can get some inspiration from Dave and do some of the same. So let's go ahead and bring him into the studio. Dave Kamara, welcome to the studio. How are you today?
Great, Matt. Thank you for having me on.
Yeah, that's good, man. Listen, last time I saw you was at one of the Michael Blanc's Dealmaker Live events. He did like a retreat. You and I went to the retreat where it was like some cattle ranch north of Dallas or something like that, right? Were you there?
Yep.
Yeah, I remember that. It's fun to go and do, best ever listeners, to go to conferences. And Dave and I were at one that was, multiple hundred people, like a lot of good powerhouses. And then a smaller group of folks from that conference went and spent another day going and doing more masterminding and shop talking and whatnot. Since doing that, I've tried to do that at almost every conference that I've gone to, right? Was that valuable for you too?
Yeah, I think it's really good because you get to talk to people that operate like you do similar things that you do, and there's less, I would say, of the commercial aspect of a conference and less of
Mhm.
the rah rah rah. Here's how great I am, but more of let's share what's actually going on and how can we help each other with common things that
Oh yeah.
we can learn from. So yeah, I think those are great. Absolutely.
It's such BS a lot of times. It's like everybody gets up on stage and sings the Everything is Awesome song and everything like that. And this is how I do. This is why I'm better. This is why I'm better. Right. But first of all, for best ever, I've never found it to be that way because it's just a different conference, different energy. The talks are always shorter at best ever. I don't know if you know this, but like we've cut them back to 20 minutes. So you better give me your best in 20 minutes. Like it's like a TED talk now. Right.
Nice.
So no 1 hour's listen to somebody drone and talk about their successes and everything like that. It's quick hits, right? But I've found the value many times at a conference, either me and Dave going deep in the hallway over a cup of coffee on how he landed this LIHTC deal that we're going to talk about, or the 72 unit that's out in the middle of nowhere, Michigan, no offense, right? That we're going to unpack. But I'd rather hear about that. And I've been to this one conference I went to, Dave. I never heard a speaker talk. I got so much done in the hallway of the conference, like equity conversations, landed a deal. It's like, I'm making more money out here in the hallway by the coffee machine, you know?
That's right. That's right.
Yeah, yeah. So I really enjoyed our conference. I love your vibe already and everything like that. Give me like the 30-second Dave for the best ever listeners. Give us the quick Dave backstory, Dave commercial in 30 seconds or less.
Sure. So I was, first of all, came to this country as an immigrant at 17 with $1,000. Went to college, kind of worked my way through all the various jobs, delivered pizza, worked at a gas station behind bulletproof glass, all the fun stories. Graduate computer science, worked in industry, and then ended up in management consulting, which took me away from family for way too long. And, kind of being inquisitive and always trying to figure out how to make more money. My first revelation was like, wow, you could buy a house and we could live in it for less than what we're paying rent. My wife and I were like, we should do more houses. Like, let's just buy as many houses as we can. And we didn't have money. So we bought a house, we bought another house. I ended up buying a duplex in Gary, Indiana, of all places. Very rough area to own property. Learned a lot of lessons there.
You bought it on pricing, right? You're like, I could buy for $30K a door, honey, right?
Exactly. It's like,
I could buy for $30K a door, running out for $1,000. What could go wrong?
Exactly. Everything's great. This is awesome.
Yeah.
Learn some lessons very quickly.
Make you a whole list of what could go wrong, by the way.
Yeah. But then essentially I was like, yeah, maybe I should keep on doing houses and just renting them out. And quickly found out that it's just tough to scale. So then I stumbled on, a bunch of podcasts about apartment investing and slowly went that route, ended up signing up for coaching. Just because I felt like I was ready to go. I had the money to do it myself. I didn't want to make the big mistakes on my dime. I'd rather essentially
nothing wrong with that.
Learn that with a mentor. Yeah. And then from there, just honestly, just my whole thing was to buy assets for myself was the original plan. So I would run into my buddies at airports, my consulting friends, and be like, hey guys, like I bought this thing and I bought that thing and I'm seeing the light at the end of the tunnel. So I'll be seeing you guys less at airports and hopefully I'll just be talking to you guys on the phone. Just kind of, tongue in cheek, kind of bullshitting a bit. But people were very receptive and supportive. And they're like, hey, you're a smart guy. We know you. We trust you. Why don't we write a check and just buy something together? And I just had never expected anyone to even consider me in that light.
I love that. Like, you're right. Why don't you are absolutely right. Why do you not write a check?
Right.
That's a great question. And let's live into that question about you writing a check for me. Yeah,
right. And so I thought about it and then I was like, you know what? No, I don't know that I'm ready for that. I just want to see my kids more, go to more swim meets and soccer tournaments and be present. That went on for probably about 9 to 12 months. And then I kind of stumbled into a deal that was way too big for me myself, but it was a great deal. The only reason not to do that deal was because I just didn't have the money to do it. And whereas like my broker was like, hey, this is very similar to other great deals you've bought and it's mom and pop. It's, back in the day where you could buy something, not do too much and it just cash flowed. And valuation was decent. So I went back to these guys. I'm like, hey, if you guys are truly serious, like here's a deal that actually works. I'll put my money alongside yours and we'll do it and see how it works. So that's how this whole thing started for me. Needless to say, I no longer am traveling around and I'm not consulting. I just had to own my own deals. And
Let me
Our
let me jump in
setup
with a
is
few. I got a few questions because you're now you're getting you went well beyond 30 seconds, Dave, and
sorry,
all that. So I got I've been so many good questions I got here. First of all, man, you got the coolest accent ever. Where are you from? And I'm
um,
trying so hard to place it. I'm like,
yeah, no,
where did he
I
come
can
from when
pass
he
for
was?
anyone and anyone, any place in the world. So I get, Middle Eastern, I get Western Samoan,
You could be a spy.
Islander,
You could
Hawaiian,
be
whatever.
couldn't you be a spy because you kind of
Yeah,
blend
absolutely, I
in,
could.
right? And the
I've been
accent's not
accused
hard to
of being a
place.
spy. I literally have been stopped at an airport saying, "Hey, like this doesn't make sense. Like, where are you from?"
You get the random check, like, oh, it's a random, 100% random check, right?
Yeah,
Yeah,
I get the random pullover. No, so I
yeah.
was in Ukraine. My
Okay.
my first language is Russian. My mom is Ukrainian. My dad was studying in the Soviet Union, and
Okay.
my dad is from West Africa, Sierra
Oh
Leone.
man.
Yeah.
On a different podcast, we could have a whole different conversation when you say Ukraine, right? But let's not don't need to go there on the Best Ever show. Maybe with a bourbon in our hands, we can talk about that at Best Ever Con, about the wacky things coming up with the word Ukraine in it these days. But okay, so you're from Ukraine, management consulting, in that, which is a lot of is that like Arthur Anderson, that kind of work where you're
Yeah.
doing a lot of
Yeah.
jet setting and living out of a suitcase and working for company A this week or company B the next week, that kind of thing?
Very much the case. Yes, walking into boardrooms and telling people what I think, and telling people that they should fire the C-suite or not, or hire people to support them.
Yeah.
It was very, very fun work, and I didn't know this line of work existed at all, right? So again, computer science undergrad, ended up doing business school, and then after that, kind of like, yeah, let's try this consulting gig. I worked for a small company that got acquired by Price Waterhouse,
Yeah.
and I'm not an accountant, right? My expertise is kind of the intersection of operations and IT. So
Yeah.
a lot of operational due diligence on companies that private equity often is willing to buy and then roll up and essentially make a platform and see what efficiencies there are in terms of when you roll something up, and how do we find operational synergies and operational efficiencies, whether that's on the sales side or the operating side. How do we, get better costs out of getting scale, right? And again, so a lot of the businesses that I was helping people buy were kind of self first generation founders that made all the errors but succeeded despite those, and there was an opportunity to go and invest and professionalize the workforce, how the businesses are being run, kind of industry agnostic, honestly. So it was very fun. Saw things across the spectrum.
Were they trying to get themselves ready to get bought by private equity by bringing you guys in? Like, okay, you guys come and help us clean and polish this thing so that private equity comes and pays me 10x EBITDA for my business.
Sometimes that, but more often the case, we were being hired by the PE guys to go and help them understand what the opportunity was. Yeah.
Okay, we're gonna buy this, and y'all to tell me how I fix it. How do I make it worth?
Or what's my CapEx plan for the next 2 years for what I'm trying to do here?
Yeah, I can see. How do you? Certainly like CapEx plans and value adds, that kind of thing. How does your experience with that management consulting arm, how does that like correlate to where you are now in the real estate industry?
So much, right? I'd say, buying a building is by far so much easier, right, than buying a business, because you're dealing with a lot less of the personnel issues, and frankly, it's a much simpler product that we're service that we're selling. And in many cases, right, like whether you're selling Cheese Whiz or you're selling fishing rods, right, it's just like the demand and that kind of thing. Like, I'm not an expert on that side. So often there'll be other people that are, but it's just so much more difficult to predict, right? And what markets are you selling into? Are you selling direct to consumer? Are you selling through some big retailer like, Bass Pro Shop or whatever? So, I think business is just more difficult. And so by comparison, what we're doing here, the models are very similar in terms of leverage, raise capital, go operate better, but it lends itself extremely well to what I'm doing now in private equity. I
think that in regards to like the outcome, right? Like I think that's how I hear a lot of people that are talking about, like people are transitioning from real estate ownership. Like, it seems like the cool kids are running over to like, hey, forget about real estate. Let me go buy an HVAC company, because this person that I saw on Instagram is talking all about how I can do that, right? And they happen to have a course that I can buy that'll teach me how to buy businesses, right? when you look at the equation, it is buying a thing that's performing at metrics A and with a bunch of new protocols and systems and processes, whatever you want to do, the bottom line changes. And when the bottom line changes, it becomes the asset becomes worth markedly more. Be that an HVAC company, be that a 50 unit, right?
Absolutely.
Yeah. So
You were
I think
talking
that like changing things to make the box more profitable, then that makes it worth more. It's the same
same concept.
process, different
Same,
levers. Yeah.
exactly. So you recently were talking to Edward Cushman, right? And he was talking about like laundromats, right? And so how you can go and roll up laundromats. Exactly the same concept, right? So most of
Yeah.
what I did was, hey, let's go buy, literally just to make it kind of a simple example, let's go buy a company that makes fishing lures, right? And then let's go buy a company that makes hunting equipment. And let's
Yes.
go buy a company that makes, duck calls for hunters. And let's like,
Complementary.
basically
Yeah.
do all this, like roll this thing up. And because you're buying a smaller business, your multiple is usually smaller. But once you have a much more sizable business, the proxy for the real estate side is NOI. On the business side, it's EBITDA. Once you have much
Yeah.
bigger EBITDA, you command a higher multiple, right?
Yeah.
And so
You-
same thing on the real estate side. Like smaller properties tend to have smaller cap rates or larger cap rates. Larger companies tend to have lower cap rates because you have more
Yeah.
units. But the concept is very similar.
Yeah, I know you're talking about that Cushman episode that he and I did, where he blew me away. I was like, "Hey, what asset class? If you, and this is a best ever listeners. This was a best ever episode just a few weeks ago that dropped." And I asked Cushman, hey, what if you could not invest in multifamily anymore? And you had to invest in something else, what would it be? And he blew me away, man. I had him pegged because I've known Andrew for many, many years, and he's like total, like the typical prototype nerdy engineer, now real estate investor guy, and I say they would love, because I love that man, but he is total absolute nerd, right? And so he comes out with coin operated laundry, and I'm like, what? Say what? That's not what I thought you were going to say. But then he unpacked it, and I'm like, okay, I got it. I see it, and I see how you would fit perfectly in that. So, yeah, that was a good episode. Let me get back to you here. Do you reside in that upper Michigan, in the Michigan area? Where is your home base?
I'm just outside of Detroit, right? So I'm basically Ann Arbor, so University of Michigan, Blue Wolverines. Yeah, so I'm in Ann Arbor, which is 30 minutes outside of the Metro Detroit area. So Southeast Michigan.
Got it. Do you believe, because it seems like a lot of your assets are in the central part of the U.S., kind of like Michigan plus, right? Have you been able to really leverage and scale, somewhat through vertical integration, whatever that may be, by investing in your own backyard? Because you've crossed, you're sitting around 1,000 units, which is nothing, that's nothing to shake a stick at. That's extremely impressive. But some investors are like, okay, like Cushman, for example, my man lives in California. Okay. He's not invested in California. He's invested in the Southeast, which is pretty much as far away from California as you can get, aside from Hawaii, right? So, but he's investing a long airplane ride away because of the, again, this is the nerdy engineer real estate investor, that he's like, okay, I see the demographic changes. He'll blow away all the data in the world as to where he is, Georgia, the Carolinas, Northern Florida, that part of the world is a good place to invest. And he doesn't mind getting on an airplane, doesn't mind scaling with remote teams to make that happen. You are a different real estate investor that has decided, is it a lifestyle thing or is it like boots on the ground, hands in? Why did you invest in your own backyard versus let me find a playground in the US that makes sense?
I think it's a combination of both. So just having been in management consulting for close to 10 years, I mean, you're literally on a plane 40 plus weeks a year, right? And so I have kids, I have 4 kids. And it was a conscious choice to say, yeah, that needs to change. I mean, honestly, that was a big factor in my wife and I saying, we're going all in on multifamily. Because I wanted to be more present and I want to be able to be, driving my kids to school in the morning and pick them up in the afternoon and go to swim meets and soccer games and gymnastics.
You're not doing that by flying to Atlanta every
yeah.
month,
So,
right?
I mean, part of it was I think I was a bit burned by the excessive travel. Not that I wouldn't get on a plane to go see a property, but if I could avoid it and don't have to, that was definitely a factor. Now, as we were talking earlier, Michigan's a pretty big state. The first couple things we bought, like I said, we bought for ourselves, and the plan was just let's go buy assets that cash flow, and we'll see what happens. The business kind of emerged and evolved when people said, "We want to work with you, we trust you, you seem to be a good operator." So that has resulted in more focus locally. And then from a scaling perspective, your question, I think the most challenging thing, and especially today, post COVID, is operations and operating well, right? It's not just buying the asset and putting the deal together, but it's actually, making sure that your delinquency is low, making sure that you're turning units in a cost-effective manner, making sure you're actually operating profitably. I was very fortunate in that when I started, having been in operations in businesses, I realized that I did not necessarily want to run my own property management business. And part of it was also luck, honestly, in that one of the first syndications I did, I had a fire on, and that fire happened 2 weeks after I bought that asset. And I found myself on a Disney cruise when that fire happened.
Oh my
so
goodness.
I couldn't leave to go see anything. And so the property management company I was working with handled it extremely well and professionally, and did not kind of try to make it into a rainy day for themselves. Way more like they just
they didn't also just say, "Hey, you got a problem, Dave. Call me when you fix the problem." Right? Like they got in and fixed it with you. That's
exactly.
Great.
They're basically like, "Hey, we know you're on a cruise. Go do your thing. We're there. It'll be fine. Nobody died. We'll figure it out." Right? And then I got back and I was like, "Here's all the things and here's what happened," but they didn't overcharge me for it.
Yeah.
And so with that episode, I essentially said, "I like these guys a lot," and I resolved to say, I'm going to bring them in to be part of my GP on any deals I did going forward.
Oh, wait a minute. Okay. First of all, how big was the property that had the fire?
97 unit.
And how many units? We
lost 12 units.
12. Wow.
Yeah, we lost one building.
Big fire.
Yep. Lost a building.
Was it vintage?
That building was a 70s vintage.
Yeah.
So no sprinklers,
no hardwired, probably no sprinklers, no hardwired smokes. They called back to Central Station, nothing like that.
To make matters worse, the place it was in didn't have like a fire department that was big enough to put that thing out. So there were like multiple little towns coming in with their fire brigades to turn this thing off.
It's all volunteer, right? It's a bunch
exactly.
It's like weekend warrior firefighter guys. God bless them. I mean, people that choose that as a side hustle or a hobby or whatever. I mean, so geez, okay.
So that was a trial by fire, kind of you learning out of a fire hose, kind of
literally, right?
Really quickly.
Yeah. What'd you end up doing? Did you put the 12 back through insurance claims?
We ended up rebuilding them, and we actually exited that asset 3 months ago for like a 250% return to all investors.
That's great.
It was a really good return.
Was it because of, not to keep picking on Andrew Cushman, but he had something like that happen, and what his property was like a hurricane thing, and like pretty much the insurance company came in, and through the insurance settlements, if you do the right thing with an insurance settlement, you can really put a better asset back. If you do the right thing with the insurance dollars. Is that what happened for you? No, that's not. I'm sure it's all through the entire enchilada equation as to why you're able to return a great profit.
I can talk about that deal briefly. So fire happened. So we bought the deal in 2019. Fire happened in September, late August. We immediately hired an adjuster, went through the whole motion. Of course, insurance came back with a much lower settlement saying, "Hey, here, take $600,000 and go away." We're like, no, we want to rebuild this thing. And then it came like the whole kind of negotiating about what they will cover, what they wouldn't cover. Of course, having an adjuster on your side helps a lot. Those guys are advocating for you. They know the building code. They know what's needed. So we went through that whole process. It took about a year for them to essentially approve what we wanted to build. But like I said, the original bid that they gave us was like $600,000. The cost to rebuild the 12 units ended up being something about, I would say, 1.7.
Wow.
So much different number. But again, because we went through the adjuster and like, hey, here's what the material costs are. You have to get all the quotes together and everything. Yeah. We finally rebuilt that thing. And then what happened, of course, it was COVID, right? So everybody was not working. So then the inspectors aren't coming out to inspect on a timely manner. It took us 2 years to get the certificate of occupancy for this thing back up. The great news is now I have 12 brand new units, and so I can raise rents on those. So So what was really helpful is when we closed that deal, we had sufficient reserves, right?
Mm.
So without that, we would have been not in a good place. But we had sufficient reserves that we essentially were able to cover some of the loss in operational income. We also had insurance, which covered loss of business income, but that was only for a year. So while it took us 2 years to get there, we were paid for the rents we lost for a year, and then we kind of ate the rents we lost for another year.
Yeah.
But once the building came back, once the 12 units were rebuilt, it operated really well. And again, this was in a small market where we were able to systematically raise rents over the time that we owned it. So in 2022, we refinanced it.
Mm-hmm.
And when we refied it, actually, the building had done so well that we were able to give everybody back 100% of their income or of their investment. So all their seed capital. And then we kept back this was a Freddie loan, right? So Freddie came out and they're like, well, this thing needs siding, it needs roofs here, it needs this and that and the other. So the rest of the refi cash we basically put back into the building.
Mm-hmm.
And throughout, this building returned about 8% a year, which is great, right? So
Even
then,
after you've given investors their money back, so now that's just infinite return on top of their
exactly.
Right.
So it was really good. And then, so after we refied, we gave people 100% of their cash back. They're just sitting, waiting for, an exit at some point. We thought we could, keep riding, in 2021, 22, valuations were going only in one direction. So we said, let's hold on to it because, most of the work is done. Like all the CapEx is done. It's just, holding on and operating well. We overspent on some of the projects. We had like a massive parking lot to do. So we were doing that out of operations. We paused distributions, but I didn't feel too bad because everybody had their cash out already. And just kept on operating and paying down whatever AP that we had accumulated. And then, interestingly, the person who sold this asset to us came back and said, hey, I would like to buy this back, and I'm doing a 1031. Would you work with me?
Huh.
So this was about this time last year. And I was like, sure, I'm not really looking to sell this thing, but it's been at this point 6 years. I'm happy to give my investors a massive return. And if you close to that number, we'll work with you. So we did. And the catch was this guy had a hotel that was destroyed in the St. Pete area in Florida with that hurricane that came through a year ago.
Mm-hmm. Yeah.
And he was like, I'm a bit tight on cash, but again, I need you to work with me on timeline. So we did a PA where it was like he had 9 months to close. And he had to put in a bunch of tranches of cash. Like it was $100,000 after the first, I think, month, and then 100 of the second month, 100 after the third month, and then from there, he had X number of days to close. So that's kind of how we worked. We closed in September, and we bought that asset for like 3.6, and we sold it for 7.5. So yes, everybody was extremely happy on that deal.
Not bad. Great story. Thank you. And what would you learn from that deal? Like, what are your carry forwards that you got that you're give me like some of your battle scars and some of your success points. I find sometimes the battle scars teach more than than the wins do, right? But like, give me a little bit of what you got from both sides of that you're going to carry forward in your career.
I learned that I don't want to build things, honestly. Just working with contractors is very unpredictable. Budgets vary. You sometimes get good quotes. You sometimes material costs go up, and then, you had $100,000 and now you're like at 130 for.
You seem to be very methodical. I don't think construction's only it's for the certain personality. Some people love that stuff, man. You seem to be way more like logical than construction would work for, right?
We got into like little squabbles with some of these inspectors that were like, because it's small town stuff, right? And they have their small town politics squabbles. I'm like, guys, I just need like a certificate of occupancy. Why are you delaying me? Because you guys don't like each other. Like, it makes zero sense.
He's also mad because you didn't hire his brother-in-law to do the electrical work.
Something. I don't know. Yeah, right. Something. So that was hard. And then just the unpredictability of what happens during COVID and how you handle that, because that literally was that rode with us. I'll say that a big learning was having enough reserves up front, right? If we did not have enough reserves up front in that deal,
That got you through the storm. It sounds like you had some storms, and
yeah,
having that war chest, so to speak. Friends of mine hate like the term rainy day money, right? But like call it what you will,
yep.
money on the shelf just in case of emergency break glass, right? So it sounds like you had a few times that you needed that cash, and if you didn't, this might not have been the same story.
Yeah, absolutely. I'll say this. I have never been unhappy that I raised additional money, right? Let's put it that way. Like,
Yeah.
there's no deal that I've worked on that I was like, oh man, I should have raised less money. Like
Yeah.
that deal doesn't exist.
We
Like
can
the
always-
worst case scenario is you give the money back to the investors and
Right.
everything's fine.
I was gonna say, if you end up raising more than you need, you give it back to them. You
Yep.
know, like, okay, you know what? I'm realizing that we're actually running pretty well, and I want to have a couple months worth of expenses on the shelf. I got 7 months worth of expenses on the shelf. Why don't I just send it back to investors? You know,
Yeah, and then people are happy because they're not expecting it, right? As
Yeah.
opposed to like,
we
hey,
don't need this. Yeah,
we had a cash, like we need money because we had a fire. Like that just is
Yeah.
not a conversation anyone wants to have. And interestingly, subsequently, we've had other fires where kind of same thing. It's like, man, we had a fire earlier this year on a different asset where this one's interesting. It was in one unit and it was contained to one unit, and the fire department came out and turned it out. And the next morning, the whole building was gone.
keep going with that story. How'd that happen?
Well, supposedly there was some embers caught in the insulation in the attic that were not put out. And so the next morning,
Wow.
by like 4 a.m, the whole building was ablaze and all of the tenants had to get out. And it was just like, you guys were here at 4 p.m. the previous evening and you doused the whole place down. How is this thing now burning
I've
down?
always found firefighters to be absent, and I'm saying this with love, firefighters.
I don't know what
Yeah.
happened there. And frankly, we have not
Yeah.
pursued it. Like, I mean, I'm not going to sue the fire department, but this was a one
You're
unit
doing the
issue
best.
that was
Yeah.
contained. And then now it literally cost us 8
As long as insurance covers you, right? Those guys
insurance
are
is
doing
covering us. So again, the lessons from that previous one we're employing here, and we're actually proceeding much faster in that this
Yeah.
fire happened in March. We essentially have the whole frame of the building up and running
Yeah.
now. And we have the trades passed, and the municipality is working with us. But it's like,
Yeah.
yes, insurance is working with us, and that's great. But like, I don't want to be the guy who's like known for burnt buildings all the time. Like at some point, they're gonna like, you have a history here.
But it's funny, not to like browbeat firefighters, man, but like I've had multiple fires. I've been doing this for about 20 years, like you have,
Yeah.
right? I've had multiple fires. It happens in real estate. It's a shame, but it does. And you own enough real estate, you're gonna have a fire.
Exactly.
So we've had fires where it's like, the firefighters did more freaking damage than the fire did, right? It's like you can't just open the door. You gotta kick it. You gotta kick it with your foot, do you? Right? And they'll take a sledgehammer to every wall to open it up. And I get to make sure there's not burning embers in the wall and all that.
Right.
But now and they soak the whole place down with water, and it's like there's a little bit of fire in the kitchen. There's the fire damage right there, but I've got my whole, now all my doors are gone, and now everything, all my sheetrock is all soaked out. Right. You're a
And
testament.
I can't blame those guys. I mean, they do
Yeah.
work that honestly, like they don't get paid enough for. So I mean, it is what it
And
is.
you're like, what are they doing? It's a life safety matter. Like, I'm not worried about your building. I'm trying to make
Right.
sure that people don't die in your property.
Right.
How about that? So I get it. And I say that with love, but it is like, you look at it and you're like, man, these firefighters did 80 grand worth of work. The fire damage is 10,
That happens. Yes.
Yeah, no, I know. Anyway, moving on. As we, I want to just take a quick break for our sponsors here, best of listeners. When we get back, me and Dave are going to completely pivot. We're going to talk about letters you guys might be afraid of, LIHTC, right? We're going to talk about LIHTC, and Dave's going to unpack and demystify that for us. And he's going to tell us a crazy story about his 72 unit that he's got going on, a deal that he finished. So I heard some really interesting stuff on how he found and financed that one. So let's hear about all that after we hear from our sponsors. And we're back. Dave, really great conversation today. By the way, we're talking to Dave Kamara from Cape Sierra Capital. Dave, really grateful to have you on the Best Ever CRE show today. I want to repivot you a little bit. Really great conversation so far. In the green room before we came in here, you and I were talking about LIHTC. And When brokers send me a LIHTC deal, I'm like, get the frick out of here, man. I'm not doing that. I don't even know how to do it. This is hoops, a lot more paperwork. Like I said, I'm just way more impatient, I think, than you are. But you strike me to be somebody who's very pragmatic and teach me the rules and I'll play the game kind of guy. So you have told me that you've done maybe multiple LIHTC deals. Can you just unpack real quick what LIHTC is and how real estate investors like ourselves could take advantage of it for investments?
Sure. So LIHTC stands for Low Income Housing Tax Credit. And these deals, at least in the Midwest, were built probably over the past, 20, 30 years to help with affordability, right? So essentially, mostly how these deals are structured is the builder builds them and gets a ton of tax credits for creating affordable housing. And so in the majority of cases, it appears that the builder actually gets the benefit of building this project and then getting a series of tax breaks. There are a series of rules to abide by. So most of the time, the local municipality and the state kind of control that LIHTC market, and they'll say that, in this area, we need to have more affordable housing, and you need to actually prove that the people renting these apartments make less than X percent of the average mean income in that market. All right. So AMI, average mean income.
Mm-hmm.
And so it could be, these people make like less than 70% of the AMI or less than 60% of the AMI. And they actually often will give you, okay, you have a 100-unit building, 40 units have to be less than 70 or less than 70%, then a few others in different categories. It is a lot of, the onus is on you, the owner, the property manager, to actually prove that these tenants actually meet those criteria. So it's a lot of paperwork, which is why, unless you have the infrastructure to do it, most people don't do it. Now, I didn't know anything about this either. The unique circumstances that I have invested in LIHTC are those cases where these contracts are about to expire. So usually this building is built and it has to be in this LIHTC program for 30 years, and sometimes for longer. So I was fortunate to be educated by a broker who knew how this worked. And that story specifically was you could buy the deal and it was at a ridiculously low price per door. My first one that I did was, I think I paid 1.5 million for 48 units at the time. So it was like about 30 grand a door. And this property was built in, I think, 1995. So it was, again, approaching that 30-year expiration point. It is a lot of work to get this asset out of the program. It's a lot of paperwork to get it out of the program. But if you successfully do so, you then can charge market rents, right? And hence the value of this asset goes up quite a bit. Now, the government doesn't want people to buy these assets and take them out of this program because they want affordability. So you have to actually list this asset for sale for about a year at some valuation that some firms can help you put together and say, this is what this thing is supposed to be sold at. In my case, for that specific asset, like I said, I bought it for 1.5 for 48 units, which was a very good price for a relatively new asset. The valuation that they came up with was about $5 million that someone had to buy it to keep it in LIHTC, which of course nobody did. And so after that year expires with nobody buying it at that price point, you have to notify the tenants that, hey, tenants, this property will no longer be in this program in 3 years. And so essentially it's a 4-year turnaround. But you have to be patient. You have to be able to have patient capital. I did it with my own cash, so I didn't have to explain anything to investors. But at the end of the day, essentially you can keep it and just keep it for cash flow and have market rate tenants in there. And again, rents go up by 30 to 40% because your caps were where they were. And then, or you just sell it outright as a market rate property. So in my case, in the first one, we ended up selling, and we, again, bought at 1.5, sold it for, I think, close to 2.9. And that turnaround was actually before the 4-year mark. So we were still at the tail end of the phasing out of the program. So it was really good, good investment, good payout. The thing to know is these properties, you're not getting the type A tenants or class A tenants. Like you're going to be dealing with some difficult tenants. And you just have to have the stomach to weather through it, and also the deep pockets to essentially bear the
Are you
payables.
when you say difficult, like I get you're these are folks that are earning below what percent of AMI?
60 to 70.
Yeah. Okay. Which is best ever listeners. That means like, give me an example, Dave. Like, give me a market that you did
30,000
a
a
deal.
year, 40,000 a year for a family of 3 to 4 people.
30,000, 20, 30 to, I mean, and it's a shame in America that we're asking people to feed a family on that, but it's good to know that there's programs there, that are help folks like that. Right. But these are folks that are earning that. So they're obviously going to be hand to mouth, right? Like if anything hiccups, be that a, flat tire, or, Christmas time that they want to, buy some presents for their kids for Christmas or whatever that may be, it's going to put a strain on their income. Is that the difficulty you're talking about? Are there other difficulties in dealing with mid to low AMI?
In that, the difficulty I'm talking about is some people will care for your property better than you would care for it, right? And others just don't. And you actually get that at all levels. But when people are more strapped financially, right, there's just less care given to your property. To the point where it's like, just report that there's an issue, right? Sometimes people just don't even report it. And they're like, well, this was broken and I just made do. And it's like, well, but if you make do, like, you're not helping yourself, you're not helping us. Like the thing is deteriorating further. That's not good.
They're not going to tell you that the roof's leaking. They're not going to tell you that window has mold around the edges of it and everything like that. Yeah, I got other things to worry about, right? So
So I mean, that's more what I'm referring to. Because I mean, if you're in Class A and B plus properties, people, I mean, tenants are on top of it. Like, they'll tell you, like, "Hey, I'm paying. This is not right. I need this fixed."
No, not for nothing, Dave. You're giving them too much credit. A Class A tenant's going to call you when they see a bug, right? They're going to be like, the light in my refrigerator is not turning on when I open the door.
That's right.
And I will not. I will be withholding my rent until that light bulb turns on.
That's right. You just pick your headache. You get a headache.
No, right. Like I saw an ant in my kitchen. So it's like, well, maybe you shouldn't leave your food out. How about that? But no, that's your problem, landlord, right? That I saw an ant. Anyway, I digress. So that's LIHTC. You've gotten into is the play for LIHTC for a best ever listener to find a property that's coming off of LIHTC. That's the way you did it, and then jump through the hoops, be willing to engage in the process, and then take it off of LIHTC over time. And now you got a market rate property, because not for nothing, not everybody, including your buddy Matt here, wants to buy a LIHTC property. So by you doing what others are not willing to do, you've decreased the demand profile, right? To the point where, like there's not just the price is lower because supply demand. There's just not that much demand for the asset. So it's going to trade for lower, and because the revenues are lower and all the things, right? So that's the play, is to buy it coming off LIHTC.
Yes. For me, that's absolutely the play. And we have another one that we've done, which is similar, which we currently own. I believe others, there's a different play, which I'm not too familiar with, but it's a play on, it's a play for high net worth individuals that want tax losses, essentially, right? You're buying an asset that, yes, the cash flows over time, you'll pay it off. But in the interim, you're just milking the taxable losses, and that's a play that other people.
Well, that's what the TC part is. It is a LIHTC brings a tax credit to the table, and depending on the state you're in, that is a federal income tax forgiveness, right? So it's like, you're a high net worth individual, or I had a buddy that did a LIHTC deal with a company you might have heard of called Berkshire Hathaway, right? They came in and bought the tax credits. It is a big deal, right? But of course, that's the kind of weight they're going to throw around, right? And so they came in and bought big tax credits for a project that he had. I've even seen a buddy that did a bank. The bank, I think it was PNC, financed the deal with straight just debt, right? And then when his tax credits came in, the bank bought the tax credits as well. So these are all things that are possible if you want to continue to long-term run a low AMI asset. Right. And this is all the stuff, Dave, that you got to learn how to do, the challenges you already talked about, and everything like that on a longer basis. And there's a game there too. But that's not the game we're talking about.
Correct. And I don't know that game entirely well. And I learned the little piece that I understand, and I
This you either do that game or you don't. Like I know people that
correct.
that's all they do, and they like honestly they don't get the game that you and I play. They don't
Correct.
understand it. Like oh, you got to go raise a bunch of money from a bunch of investors. How about I just find a deal and get XYZ corporation or whatever to go buy these tax credits. I find that when you play that game, the most of the cash flow goes to the not to you as the owner. So the way you play the game is you make a ginormous, like pinky next to your mouth fee when you buy the property, and you just run it to expenses, and then you make some money when you sell it. So the money's
Correct.
bookended in
Correct.
profit. It's like big front end, and if you play it right, big back end fees when you buy LIHTC deals. Yet again, you and I are speaking out of turn. Hey, not the game we're playing, but that's what I heard how you do it, best ever listener. That's why we're here. When I
Yep.
wind up, Dave, before I wind up, can you tell me the 72 unit that you just wrapped, or that maybe you're in the middle of now? You've told me offline that's very interesting. Another acronym in there called HAP, HAP. Tell me about the deal. What is it? You said it took forever to close. So tell us a bit of a story with some lessons learned on that 72 unit deal.
Yeah. So this deal is in northern Michigan. It's in the Upper Peninsula. Um, a few years ago, we bought some assets in the city of Marquette, which is about 30,000 population. The whole county is about 60,000 people. Small market on the shores of Lake Superior. Beautiful, beautiful area. Lots of tourism. There's a university. There's a major, massive hospital up there, like just newly renovated. Northern Michigan University is there. There's a ton of mining. So about 25% of the iron
Really?
ore mined in the country comes out of that area.
Of iron ore.
Iron ore, yeah.
Do
And the
you
whole
believe that's
United
why is that I'll get weird with you. Is that why auto manufacturing is in Detroit? Is because they were getting the iron ore for the
I'm not
cars
sure why it
way back
is.
in the day?
They definitely get iron ore from up there and they ship it down the Great Lakes. Absolutely. Yes. That comes
Yeah.
down
So we
through.
figured that out. Yeah.
Yep.
Okay. There you go.
So you can get ocean going ships all the way to Lake Superior and Duluth, Minnesota through the St. Lawrence Canal and then up the Detroit River, up Lake Huron, and then up over that way. It's very fascinating. It's a very interesting place. But I digress. A couple of years ago during COVID, we bought a 124 unit up that way, and it ended up being one of the best markets that I operate in because of the lack of competition. There
Mm.
is no new construction up there. Population growth is flat to maybe slightly negative. But like I just mentioned, it's a very diversified economy. People up there love the outdoors. It's pristine, clean. And so nobody, like, again, builders aren't going to say like, hey, let's go build 100 units up in Marquette, right? It's just not their cup of tea. So we bought this asset and we were just like, hey, we're going to renovate it because it also is 70s vintage. But we were floored because people were literally begging us to just give them the unit just with doing no upgrades, just sweep the floors and we'll move in
Wow.
at $100 above what the person just moved out from. So that like was very unexpected. And that market is very unique and interesting.
Hmm.
So fast forward to today, we own about, I think, 240 or 250 units up there. I get called by a broker out of Chicago. It's like, hey, we have this deal. It's in Ishpeming, which is a town 15 minutes away from Marquette. Are you interested? And the team we have up there is extremely good. Our property management team and the maintenance crew, just really good guys, super sharp, super motivated. I'm like, yes, I'm interested. I love that market. So I started speaking to this broker and learn more about this deal, 72 units in Ishpeming. The deal has 42 units of the 72 that are on a housing assistance program, which is essentially kind of like LIHTC, but it's a voucher that the tenants get, right? So every 5 years, you have to do a rent study to say what's the average rent in this area for 1 bedroom, 2 bedroom, whatever you have. And the government says, okay, if these people qualify, which they need to qualify with the government, they will get, you, the landlord, will get X amount in rents, right? And sometimes those rents could be quite high depending on what the local market looks like. So the whole deal was there was a gentleman that is out of Minnesota that owns a bunch of these HAP contract deals, and he's in his 80s, and he only had this one unique asset in Michigan. Everything else he has is in Minnesota and South Dakota, and so he wanted to sell this one. The numbers made a ton of sense. We ended up buying it for $3.8 million for 72 units. So again, a decent valuation price per door. And I know what that market can be. And I have a very good team up there that I trust. The difficulty was the HAP contract had to be transferred from the current owner that was selling to us. And with that, you're dealing with, again, the Department of Housing and Urban Development, HUD, and they just work very slowly, right? And again, the people, I don't think this is the majority of what they do, which is transferring these contracts from one owner to another owner. But for context, we signed our PA to purchase this asset in August of 2024, right? So I was thinking I'd be closed, in the latest December of 2024, like if things go really long. We ended up closing April 15th of this year. The majority of that time was literally just spent waiting for HUD to get back to us to say, yes, you have submitted all the documents, you've checked all the boxes, we're good to go. Right.
Wow.
And it was just, at some point, like, right, my investors are like, hey, is this deal happening? Like, what's going on here? You want to go invest in other things? I'm like, yeah, you should. If you have something, I'm not going to hold you, but yes, the deal is happening. I'm just waiting for somebody to call me back. It was very difficult. And of course, like the whole upheaval with what happened with HUD and the current administration didn't help. Where you
did the government shutdown thing? Because I had people that were waiting. I had friends who were waiting on SBA loans, right?
The shutdown thing happened later, but when the new administration came in, they literally announced like they're cutting, I think it was like 40% of jobs at HUD, right? And so I don't know. I'm sure that caused a lot of angst. So we're dealing with the HUD Detroit office, but people are running around not sure if they have a job and who's doing what job, and like it's just like you call there, they're like, yeah. Did you send us all the stuff? Like, yes, here, I'll resend it to you. Please let me know what you're missing. And then it goes to HUD Legal, and HUD Legal just, sends some emails back critically saying, here are the 12 questions you need to answer. But yes, we got it closed. It was a very interesting deal. It's operating really well. I'm very excited about it. I guess, it's interesting how these different government programs work. I'm not trying to be an expert in them, but when they make sense, I'm willing to put in the work and time to learn about them and see if they work for us.
Yeah. No, I get that. That's so looking at doing that deal, looking back on it, right? There is a time value money, right? You lost a lot, not lost, right? But it took a lot of time, took a lot of patience. Yet again, that this is like the overlying thesis of today's interview is the value of being patient, in that, right? And being willing to do things that require a little bit more time, because impatient people like myself, no way. I've already lost the squirrels have already called me and I'm already going other places and everything like that, right? I'm not waiting on that deal. Knowing now what you know, is that a niche that you would want to lean into to buy these HAP deals? It's going to take a while to get HUD to the table. HUD seems like they take a while to do everything. Is this something that you want to do more of now that you've done one?
I think I am still conflicted, right? I think at the end of the day, we came away with a very solid property that was very well taken care of, because again, HUD kind of demands that it's maintained well, and they stipulate things.
Yeah, they're up your butt, man. HUD's I had a buddy of mine that has a lot of HUD properties, and he said that HUD in essence becomes your business partner. Because they're going to come in and they're going to say all the things you need to do. And there's very favorable things that they can do for you. I'll give you an example. You got a HUD on a multifamily asset. They will reduce your interest rate. If rates fall below a certain percentage,
Correct.
They'll drop that for you. And they'll give you a 30-year fixed mortgage at today's rates, right? No more, rates reset in 5 years, no more floating rate, no, none of that. HUD will do all that for you. But in exchange for it, it's going to take you 9 to 10 months to close anything, right. Right. So I've heard like either love them or you hate them, right? And you have not decided yet because you just closed recently.
Well, so to make a distinction really quickly, and for listeners, HUD is huge, right? And when people just say HUD loosely, like there's many different programs. There's HUD loans, which is what you just mentioned. HUD loans are great in that, exactly what you said. You lock up a rate. So the first property I bought during COVID, my concern was, it's COVID. Like, is the world ending? Are people going to be paying rent? Like, this was early. Nobody knew what was going on, right? The 10-year T-note was at 0 or something. Like, the rates were nuts. So I wanted to de-risk how much capital we're putting in. So I'm like, is there something that I could put in less than 20% down? And indeed, a HUD loan allows you to do that. You can leverage up to 85% LTV. So on that very first deal, we have an 85% LTV loan that is at 2.4% fixed for 35 years, right? How is that deal not going to cash flow?
Yeah. Well, that's also, is that rate transferable? So you can transfer it to others?
Correct. Yes, it's an assumable
Hey,
loan.
you're not getting 2.4 today, right? You
Ever.
walk in
I
the door
don't think I'll ever get a 2.4 ever again, right?
Yeah,
In my lifetime.
maybe that. I'm glad you got it. Maybe 2.4 should have never existed, right? Maybe there should be a barrier.
That
to
is less
entry
than
to
inflation, right? That's like literally people giving you money to buy this deal.
Yeah,
That's less than inflation in any market. So that's the HUD loan program. Yes, it takes forever to close, right? We recently refinanced a property that we bought in 2022, as many people did with a floating rate loan. Refinanced that into HUD because we got a 35-year amortization. And again, they give you a lower interest rate than you need to. We refinanced that. We closed that a year ago at 5.24%, right? So that's great. But HUD came in and said, you need to do a brand new parking lot. You need to replace all your HVACs in this property, which is, by the way, only 25 years old. And they're like, yeah, just do all of them because those HVACs are about to go out. So massive burden on you, the operator, but in exchange, you're getting a low rate and you're basically getting a great loan. And then this HUD HAP deal is separate. There's no HUD loan, but there's this HUD voucher program for tenants. I'm saying I'm still conflicted because, to your point, there's a time value of money, right? And at some point you're like, well, am I staffed? Do I have enough volume of HUD things to do that I can allocate people to go run those things down? And we just know that it's going to take X amount of time. Or do I go chase things that I can close in 3 months or
but there's a lot of people that want to trace things they can close in 3 months. And I think that that's maybe the thesis of the show, is that the benefit of patience is that you're willing to do things in general in real estate. And there's a lot of examples you and I could think of that are outside of, time, but there's value in doing things that no one else is willing to do. It's still a good deal, but it's going to be, I'll say it, a pain in the ass. It's going to be a pain in the ass to do the thing. But if you're willing to wait or jump through a ton of hoops or stand on your head for 13 minutes, whatever it may be, you might get access to something that the majority of the investing population is not going to be willing to do. I mean, that sounds like a pain in the ass. I think I'll just go find something that's not a pain in the ass. And I'm not saying that you love pains in the asses, but there is a benefit in this instance to be patient, right? And you get access to stuff that now nobody else wants to wait for.
Exactly. I think our approach has been so far to just be flexible and approach the situation as it makes sense or not, right? I think definitely I probably would not do this kind of a HUD HAP assumption of contract deal in the 2021 timeframe when there's many deals to from and rates are low and you can just kind of shoot fish in a barrel, so to speak. But I mean, in today's market where there's not a ton of good deals that are valued properly or appropriately, this one presents a kind of sort of unique opportunity. Like, okay, I'll go learn something new. It's definitely valued right, and it'll cash flow for my investors. So I'm willing to consider it, right? So I think it depends on what's your opportunity cost, right? Like in today's market, there's not 10 deals staring me in the face that are, sure things. I will spend some extra time on this one that looks like it's well valued.
Dave, you and I've been investing for long enough, man. There's people like to have this nostalgia that there was the good old days of real estate investing. It's always been there's always been a thing, right? And whatever the thing is, a couple of years ago, everybody and their mother was trying to buy multifamily. And so if you want to do a deal, you're going to have to overpay just to get in, right? That's the pain in the ass. I don't remember there ever being a day, even like when I was investing in 2008, 9, 10, like I was around at that time. And there wasn't like 9, 10 deals facing you. There were opportunities, but nobody wanted to bankroll them. Everybody thought the world was about to end, right? And so it was hard to get investor equity. It was hard to figure out a way to put the deal together. There was an opportunity, but it's like, well, shit, man, is this deal going to drop another 50% in value next year, or is it going to eventually go back up? Right? There's a lot of question marks back then.
Yep.
So I think we've really underscored the lesson for the day here. Dave, I really appreciate you coming on and giving us another way to look at things here on the Best Ever CRE show. Folks that want to come and join you on your ventures or hear more about you or pick your brain a little bit, come join you up there and just outside of Detroit. How would they reach out to you to make contact?
Our website is capesierracapital.com. That's Cape as in Superman's cape, Sierra as the mountain, and capital. Cape Sierra is a nod to Sierra Leone, which we talked about briefly. And also I'm on LinkedIn. I'm not really on a ton of social media platforms. Find me on LinkedIn. It's David Kamara. I'm pretty easy to find if you want to reach me.
Kamara, Kamara, guys. Look up Dave Kamara on LinkedIn, on social, or go to capesierracapital.com to connect with Dave and to hear more about what he's up to. Dave, am I going to see you at Best Ever Con? Then the answer is yes.
I'm considering, because again, I have 4 kids and I do not ski, but I snowboard. So they don't allow us at places like Deer Valley and such, but I'll probably find you there.
No, they'll let you. I'm going to Solitude with my family because it's right there. It's kind of the one that nobody goes to. That's why they call it Solitude, right? So Solitude and Alta and all those are all right around that area. So I'm going over President's Day weekend with my family to go skiing, and then we're going to go hang at Best Ever. So I will not be the only guy with kids running around at Best Ever. So
we love Park City. We typically do canyons and park.
It's going to be bougie.
Yeah,
Park City's bougie. Park City's fancy pants. You drink champagne and all that kind of stuff. Yeah. Anyway, I hope I see you at Best Ever Con, and I hope the Best Ever listeners get to enjoy more of your company at Best Ever Con as well. I will certainly be there with bells on. So, Dave, thank you for joining us today on the Best Ever CRE show, bud.
Thank you, Matt. Appreciate it.
Guys, I really love that conversation with Dave Kamara, and I like the concept of being willing to do deals or a little bit more of a pain in the neck with regards to time or things like LIHTC or stuff that other people don't want to deal with. If you're willing to deal with things that other people aren't willing to deal with, then you are lowering your competition pool right away. Think about that. I'll say it again. If you're willing to do things that other people are not willing to deal with, you are lowering your competition pool, right? So what in your industry, that's your homework, Best Ever listener, what in your industry, is there are there places that there might be deals or opportunities that most people avoid, perhaps that you avoid because it's a pain in the neck, whatever the thing may be, was LIHTC or dealing with HUD, dealing with the government. Nobody wants to deal with the government. But if you're willing to deal with the government and nobody else is, guess what? You're the only one at the table. That's why deal prices are lower, right? There's other examples of such out there. But think about that when you guys ponder how you're going to grow and expand your businesses in 2026 and beyond. That's my little tip of the day. If you guys like my tips of the day, and you guys like what I got to say here on the Best Ever CRE show, along with the other hosts, why don't you do us a favor and subscribe to this program? Why don't you do us a favor and like this program on your favorite podcasting app? And why don't you do us a ginormous favor and think of somebody in your network that's a fellow real estate investor that needs to get outside their buy box and get outside their current niche and maybe get into something a little bit tighter and a little bit more interesting. Forward this along to others. I'll see you guys at Best Ever Con coming up in February, by the way. So grab your tickets at besteverconference.com. Use the coupon code podcast10, all capital letters. I will see you guys there. And I will see you guys in the next Best Ever CRE show. Thank you for joining me today. Until I see you again, have a best ever day.